Hi, good morning, and welcome to our webinar on the KraneShares Artificial Intelligence and Technology ETF, ticker AGIX, AGIX. And we're going to talk about how we provide access to some of the leading private AI firms in the marketplace, like Anthropic and xAI. My name is Jonathan Shelon. I'm the Chief Operating Officer at KraneShares, and I'm joined by some esteemed guests today. We start with Max Chen from Etna. We partnered with Etna to develop the strategy for AGIX and gain access to leading AI firms around the globe. Max is a veteran within the investment industry and an AI native investor. He's worked at prestigious firms such as KPMG, Ping An, and Sequoia. We also have Derek Yan. He's our senior investment strategist here at KraneShares. Derek and I have been working together for 10 years. Welcome, gentlemen.
Thank you.
Now, I seldom get excited as I am today, and it's because of the important role that AGIX plays in the ETF marketplace. It's also because it's my daughter Layla's birthday. Happy birthday, Layla. So, fun fact number one. Did you know that over the last 30 years, the number of public companies listed on US exchanges has actually shrunk by 30%? But why? Some of the companies certainly get taken private. That's one reason. But the main reason is that companies are staying private longer. And given the growth in PE-backed firms, and those numbers have exploded 6x in 30 years, PE-backed firms, many of the best investment opportunities are just not accessible to most people. Fun fact number two, when investing in popular tech indexes like the NASDAQ 100, while the average weight of each company is 1%, the top holding, quite frankly, NVIDIA, is currently at 10%, while the smallest holding is only 0.1%. So imagine the biggest thing you own is 100 times larger than the smallest thing you own. Now, this creates significant concentration risk where the top 10 names represent more than 50% of the whole index. So we've addressed each of these challenges within AGIX to create a more robust investment approach. As we progress in our discussion today, I'm going to ask that you listen to the answers for the following questions. Question one, can I access private companies that are among the leading tech firms and would rank highly among the global leaders if they were public companies? Question number two, is there a more thoughtful way to invest in leading tech firms, public or private, than just ranking them by size or market cap? Now, before we get going, I have a favor to ask. We want this to be an interactive and lively conversation. We're live streaming this presentation on our website at KraneShares.com and also on Zoom. If you're viewing this from the website, please email your questions to info@KraneShares.com. And if you're in the Zoom, please submit your questions via the Q&A button at the bottom of your screen. Additionally, we're offering one CIMA and one CFP credit for watching this presentation, and you can email ce@KraneShares.com with your CIMA or CFP number to secure your credit. Okay. Now, at KraneShares, we manage over $10 billion across 30+ strategies, and what we're best known for is innovation and access. We began the business by creating thematic strategies focused on China. And you could see that right there in the upper left-hand corner across our China thematic suite, we have KWEB, which is a leading internet and e-commerce ETF. And we have a number of other thematic strategies to give you surgical access to some of the best opportunities in the China markets. We're also a leader in climate investing. We have a suite of climate-aligned strategies that focus on carbon credit investing, which is a really important opportunity in helping address some of the climate challenges. We're also a leader in alternatives, developing strategies that have low correlation to traditional stocks and bonds. And we do that across fixed income, managed futures, and even equities. And finally, we have a suite of well-established, thoughtful global strategies that provide unique access, differentiated returns, and something that would be hard to achieve on your own. And AGIX is a perfect example of that type of strategy, but we have many, many others to choose from. So at this time, what I'd like to do is hand things over to my colleague, Derek, to walk you through some of the key points around AGIX and what makes it such a unique strategy. Derek, the floor is yours.
Thank you, Jonathan. Thank you, everyone, again for joining the webinar on AGIX. Please go to the next slide. So AGIX is quite unique. It's one of the first ETF actually hold both public and private pre-IPO AI companies in one ETF. So when we look like, I don't think we need to really introduce more about AI, because I feel like everybody's now using AI. And everybody is wondering, how can I invest in AI? There's so many AI, I think, investment solutions or like other ETFs out there, but AGIX is quite unique, I think, in two ways. Just look at like some legacy AI ETF. Most are using an index approach provided by traditional index provider that invest in AI based on either revenue or traditional sectors. And we think that passive approach, or just like the approach that's geared towards traditional investment research, is outdated. So for AGIX, we partner with Etna Capital, as Jonathan mentioned. Etna team are funded by AI native investors and venture capitalists. So they have a deep insight and deep connections with the foundational model companies, such as xAI, Anthropic, and application companies such as Perplexity. So those deep insights actually can help us create an AI score that identify the companies that can be benefit most from the AI technology breakthrough. So that makes AGIX quite unique when investing AI. And second thing, AGIX can invest in the private space. As Jonathan said, like companies are staying private longer, and especially for AI, because it's such a new thing, the most critical companies in the AI space actually are private, namely those foundational model companies, who's actually driving this wave of technology change. So with those two characteristics, AGIX offers investors a comprehensive way to invest in all the AI companies across the AI value chain. So in the next page, you can see that we have been through multiple technology waves in history. So each wave, going back to like mainframe, to PC server, most recently cloud mobile, and now we think this wave is AI. If you look at each wave, there's two observations. Each technology breakthrough actually create a group of companies that's creating massive amount of value for investors and the society. And the second observation is each wave is actually bigger than the previous wave, because each wave is actually additive. If you think about the mainframe, you provided infrastructure, provided the system. On the PC, you have data, you have operating system ready. Then with all the data going to the cloud, going to mobile, everyone in the world almost are now connected on the mobile apps. Now, AI is so special because it's adding intelligence on top of all those layers of the systems, of the data, of the applications that's already existing in our world. But this wave, we believe, is a much bigger opportunity and it's much faster. Just look at the example of ChatGPT. It becoming like just within 3 months, it reached 100 million active users. We have never seen that in history across the previous technology wave. So that's why we feel those companies that can actually drive this wave of AI is going to create much bigger and much faster valuations and opportunities for investors globally, represented by companies like Anthropic, OpenAI, NVIDIA, and xAI. So in the next page, you can see that AGIX, with that philosophy, we really want putting the company that can drive this wave of technology breakthrough into the portfolio. So that's why we partner with Etna Capital to get direct access to those private companies. So AGIX as a fund is a shareholder on the cap table of xAI and Anthropic. We added Anthropic on March this year and xAI recently on July. By the time we add xAI, that's about, currently, I think as of July, it's about like a 3.3% of xAI and a 2.6% of Anthropic. And this ETF, even holding private companies, actually offered daily liquidity. So if you look at the spectrum of liquidity for the vehicles offering private market exposure, actually there are several options. So traditionally, most investors access through private equity or venture capital funds. That's totally illiquid because probably mostly you have like 10-year lockup and charge 220 mostly, but you have 100% exposure to the private. Then traditionally you have traditional ETF providing daily liquidity, but have no private exposure. So in between, you have several options, right? You have interval funds providing quarterly liquidity with some private exposure, but there's a whole access issue. And for AGIX, we believe we create something that's quite unique in the liquidity spectrum. It provides daily liquidity and offers a certain level of exposure to the private market. So because of the regulation on 40 Act fund, we cannot invest more than 15% into the private companies, but that's a very decent level in terms of investment portfolio. So we think AGIX actually can have a benefit to investors providing daily liquidity and providing a decent allocation to the private. So in the next page, you can see that AGIX has actually an ecosystem approach investing in AI companies. We have about 25% investing in AI hardware companies like NVIDIA, Vertiv, SK Hynix, SML, Arista, and TSMC, the companies that's really making the AI data centers and the semiconductors, powering the computing of AI large language models. And we invest in AI infrastructure and the foundational model company themselves, like xAI, Anthropic, but also like Cloudflare, the cybersecurity companies, and also a lot of cloud companies or enterprise operating systems. So those are really the infrastructure that the models can be deployed and can be used by those application companies. And we invest in AI application companies as well. It's about like 30% of portfolio. You have companies like Duolingo, ServiceNow, SAP, Salesforce, Meta, and Tempus. So that ecosystem is capturing all the important companies within the AI value chain. So next page, you can see that we use a process-driven framework to identify those companies. Starting with a universe of 2,000 to 3,000 companies, we narrowed it down by looking at it like AI relative industries. That's like 300 to 400 companies. Then with that, we have an AI score that we partner with Etna to really have their insights when they work with the foundational model companies and they do analysis on the AI application companies. So based on AI score, there will be 40 to 50 companies be selected as the final basket. The weight will be based on the AI score and their free flow market cap. There's also some capping on the category and a single company. And this portfolio is rebalanced quarterly. So in the next page, you can see that with this framework, the most importantly is the AI score. That's how we really differentiate from most legacy AI ETF. Because the AI score is really the insights we have with the foundational model companies and the latest technology around AI. It looks at AI relevance. That is the AI revenue exposure of the company currently and their product progress on the AI. And we also look at AI readiness, which is the AI revenue visibility, and also look at how the business model going to be positively impacted by AI. So that scoring system, creating a systematic way to capture the latest dynamic in the AI industry. In the next page, you can see that currently we are actually allocating across multiple AI layers of the value chain, from 25% of AI hardware to about like 46% AI infrastructure, and then to application. But this is a dynamic framework. For those investors who joined our webinar a year ago, you probably remember that most of the weight was actually in the AI hardware. As the early stage of investment, most of value actually focused on the hardware part, the companies building the AI semiconductors and AI data centers. But if you look at the portfolio now, as the AI score has been quarterly dynamically changed based on the value migration, most of the weight actually going to the infrastructure and applications now. This is very in line with our long-term view. Just like many technology breakthroughs in the past, the value is going to be migrated from the hardware to infrastructure and mostly finally to the application side. So we're going to dynamically adjusting the value chain with our AI score framework. So in the next page, you can see with that framework, the AGIX actually outperformed most major growth and technology indexes since our inception. We have launched AGIX over a year now, and within that time frame, AGIX has delivered about 30% total return compared to NASDAQ 100. It's only 18.4%. The technology sector index is about 17.7%. S&P 500 about 15.9%, and the semiconductors only 5%. So that outperforms really demonstrate that framework we have established for AGIX can actually, in the past, have delivered some quite strong performance against the most commonly followed technology and growth sectors index. And that with that framework is not actually adding a lot of volatility. If you look at annual volatility and risk, AGIX actually has a better risk reward compared to many other technology and growth indexes. So in the next page, you can see this is the fact sheet of AGIX. To sum it up, so AGIX is quite unique. It has a framework that incorporating the insights from the AI engineers, AI native researchers, and AI venture capitalists to really reflecting the portfolio dynamically to capture the latest trend in the AI industry. And it also adding companies that is so critical for this wave of AI technology breakthrough, which is the foundational model companies. So with that, we listed the AGIX on NASDAQ, and we offer global investors a way to really investing into the AGIX. So can we go back the slide to the, yeah, so you can see here's the, we currently have about like 45 million in the fund, but we believe as the more communication and investor education, this portfolio is going to be a solution for most investor when it comes to investing into AI. Now I'm going to hand it over to our partner, Max Chen, to really give an outlook and more deep dive into the private market in artificial intelligence. Max, please.
Thanks, Derek. Can we have the slide of Anthropic?
Good.
Slide 13, please.
One page. Yeah.
Yeah.
Please.
Yeah, I think the reason why we include Anthropic and xAI into AGIX as our first exposure to the private market resonate a lot of our understanding of how the market will evolve and what's the end game for AI. I think for Anthropic, we value very much on their approach to focus on the enterprise market, because we believe that enterprise market will be hugely empowered by AI, and it's going to be massively bigger than the consumer side of AI applications. So Anthropic was founded in 2021 by former OpenAI executives, Dario and the team, and author of GPT-3. So they focus very much on like safely and responsibly deploy AI into the enterprise world, and at the same time aligns with human values and societal well-being. By now, I think Anthropic have already differentiated themselves by providing top quality coding capabilities that have been used by a lot of developers in the space. Even anecdotally, OpenAI is banned from Anthropic for using Anthropic's coding model to improve OpenAI's model development. So I think that reflects Anthropic's competitive advantage over other model companies in the space. And at the same time, you could also see their revenue grow really, really fast. They almost nearly 4x growth since the start of the year, reaching 4 billion in annualized revenue, a growth speed that you seldomly see in any public companies in the space. I think that's our conviction on Anthropic, given its enterprise ready AI capabilities. Next slide, please. And for xAI, I think that reflects our conviction on the embodied AI. If you look at xAI, they are the fastest model companies that have been catching up with the SOTA models over the past 2 years. I think in the past 2 years, OpenAI have been a market leader, obviously, together with Anthropic, but xAI out of nowhere and quickly built a large class of GPUs that reflected xAI's team in terms of execution and also the ability to optimize end to end. I think thinking about the end game, a lot of the competition between model companies will end up being the competition on price on the cost. So the capabilities to optimize end-to-end from silicon layer to model layer is crucial down the road. I think xAI team, given their track record in developing their models over the past 2 years, and also building a massive GPU cluster, show that they will be one of the market leaders in the future among those AI competition. And I think xAI also lies on a massive distribution channel, given their relationship with Elon's ecosystem, including X and also Tesla, and numerous business environment that could provide real world reward for the models to learn. So that's the reason why we are also bullish on X and bullish on their capabilities in blend the AI capabilities together with a real world embodiment that offered by Tesla and maybe humanoid robots developed by Tesla. Back to you, Derek.
Thank you. Yeah. Thank you, Max. Now we just need to go through some disclaimers, but I just want to encourage everyone who joined the call on the Zoom or on the website, please send your question to info@kraneshares.com. And for the investor who joined via Zoom, please submit your question in the Q&A button below. So now we're gonna have a discussion moderated by our COO, Jonathan Shelon, with Max to have a discussion on the landscape AI and their outlook on the AI going forward. Please, Jonathan.
Fantastic, Derek. Thank you, and Max. Grateful for your insights today. And just to open up by kind of re-emphasizing what AGIX is as an ETF for our audience, right? So what we've done that's very innovative is we've taken a traditional ETF and we've partnered with Etna to be able to invest in private companies that you cannot buy on an exchange. And that's permissible. You can own up to 15%. So we've really created this public-private vehicle, recognizing that so many of the opportunities in the AI space are just not accessible on the stock market. You have to go and invest in these things privately. So Max, along these lines, I gave a little bit of a background about you, but I think it'd be helpful in your words for you to tell us a little bit about the background of the Etna team and explain how you've been able to build these relationships with leading AI companies like the ones that we own, Anthropic and xAI.
Yeah, sure. Thanks, Jonathan. I think, in short, Etna team was composed by ex-Sequoia professional investors and operators from top technology companies. So actually, we value a lot on deep research about the technology, about the company, and underwriting of the founder in order to understand not only about what's going on right now, but also what's about to happen in the future. So, our approach not only, relies on our relationship among the operator world, but also our relationship with the researchers in different AI companies. Regarding the operator relationships, our partner Saul was an ex-cruise engineer, a company that have been acquired by General Motors. I think he built an extensive network among the operators in Silicon Valley. They value a lot of his technical expertise and background. I mean, speaking the same language with the founders are crucial in building relationships. And at the same time, the team also built an extensive relationship with a lot of the AI researchers in the space. The reason is we want to understand what's about to happen in terms of scientific development in the space. And also it's a totally different vibe talking to the researchers and scientists. It is important for us to keep our head, very clear during the current hype.
Fantastic. Yeah, what I'm really struck by in what you're describing is you have a team of people that can go bottom up, very technical, but also top down and understanding the trends that are happening across AI And as Derek was describing, how things ebb and flow across the different segments of AI over time. So this is a rare combination where you have kind of the technical expertise and the macro experience in investing in these companies. And obviously you have these relationships that we've been able to leverage. Now, along those lines, ChatGPT is a household name. Everybody knows ChatGPT and therefore OpenAI. But there's a lot of growth trajectory for companies like Anthropic and xAI. And some of the pushback to investing in private companies might be, why do I need to do anything differently? If I've invested in the NASDAQ for 20 years, I've earned 15% a year. You put in $1 20 years ago, you get $16 today. Public equities are just fine. Why should I consider having something that gives me access to these private companies? What makes their growth trajectory special?
Yeah, I think we are at a time of a rapid change. I think a lot of startups in the space are thinking about how to disrupt incumbents in this way or another, aside from inventing something new. And I think, especially in the AI era, we kind of think about this in different stages of involvement. In the first stage, given a lot of incumbents have capital, have data, have compute, they could be the early winners in the first act of AI. But down the road, I think a lot of startups will show up, and as the model becomes more proliferate and penetrate into different industries, I think the startup will start eating the pie of the incumbents. And during the process, I think you want to be involved in the change of value, and you want to have a holistic exposure by accessing all those startups and challengers in the space. And the change could be very, very fast. I mean, if you were able to invest in an index that is, weighted by market cap, then the winners of the last 10 years might soon to be the losers in the next 3 years. And you definitely need a very dynamic and scientific approach to rebalance your portfolio in order to embrace the change that's about to happen.
I think that's very well said. And, we use the term startup, but I want to remind people on the webinar that if you look at the NASDAQ 100, the largest company, NVIDIA, is over 4 trillion in market cap, and the smallest company is 18 billion. Many of the companies that we're talking about that are startups, quote unquote, in the private fund space, in the private company space, are worth tens of billions themselves, maybe even 100 billion plus. So if they were public companies, they would be in the top half of the NASDAQ 100 universe. So these are, we use the term startup only because they're private, only because they've been around for 4 or 5 years. But if these companies choose to be public, they will immediately be some of the largest public tech companies in the world. So
yeah, I totally agree. Let's use generational companies instead.
Right. So how difficult is it to gain access to these companies for everyday investors? Now it's easy with AGIX, but outside of AGIX, how does someone gain access, and how is it different, or easy is it to use a platform like Forge or private brokers? Just explain to people kind of how things work in this space a little more in more detail.
Yeah, I think back to the genesis of AGIX. I mean, the purpose of launching AGIX is to in part democratize the private investment for investors, and also allow us to be prepared in the future of AI that will capture most of the value being created, and to allow the investors' portfolio to be so-called AGI ready. Access to those leading private assets is important, to have a holistic coverage of the data that we have been discussing. So accessing the leading private AI companies is exceptionally challenging for everyday investors. I think these companies have very stringent cap table control, and generally only accept institutional investors like venture capitals and also highly connected individuals, if you're lucky to spot them in the early days. So, I mean, platforms or brokers offer secondary market shares, but these often, come along with high markups, opaque pricing, and illiquidity, sometimes uncertain legal structure. So, what we are trying to offer is an institutional quality access, and we negotiate directly with the management of the company, and typically at primary or tender secondary rounds. And this will definitely result in better pricing, clear governance, and a genuine ownership of those companies. So those terms are difficult to find and to replicate by a very fragmented secondary market or broker market.
I think that's an excellent point. Our investments today in these two private firms, Anthropic and xAI, are done directly, right? We are on the cap table of those companies. There's a clear ownership. There's no confusion that we own those shares. And there are other ways to gain exposure, as you pointed out, the secondary market and SPVs, and those could be other avenues. Those aren't the ones we've taken in investing in the two companies we've invested in. What is different? What is the difference then if you went down the SPV path versus owning directly on the cap table?
Yeah, I think on that, like we discussed, it's going to be very opaque structure, multiple layers of fees, and a liquidity issue. I think most importantly, we choose more sustainable path because we want to be a new breed. We aim to be a long-term partner for generational private companies, like we discussed, to become the liquidity provider that not only benefit the investors to be able to have reliable access of the private company shares, but also, enable companies to have a reliable partner that they can, work with, and we can provide liquidity to the new round investment or secondary transaction orchestrated by the company. So it's going to be a more sustainable model that will benefit all the parties involved.
Fantastic. So I feel like we've covered a lot of ground on investing in the private names, how we've secured access, why it's efficient. And so we've addressed my first question that I asked early on, right? How do you gain access to these private companies? I want to shift gears a little bit and focus on the public markets, recognizing I think there's a lot of risk. We've talked about the risk built in to public market investing, where you're basically leveraging momentum and owning more of the things that have done well historically, but not necessarily positioning yourself for future success. And quite frankly, this is why we believe AGIX has been successful over the last year and outperforming, because we're really trying to take a forward-looking approach to investing. Can you talk a little bit more about this proprietary AI score that we're using to evaluate public companies, and how knowing what you know about the private company space actually is an important input into that AI score, how that knowledge actually blends in some way?
Yeah, that's a great question. I think in summary, the purpose of the AI score is to allow investors to, not missing out generational companies while not being hyped by the current market. Let me explain that. There are two pillars in the AI score. One pillar is called AI readiness, meaning we are looking at the, growth potential of the company. Whether or not the business model will be empowered by AI. Are they going to be a market leader if AI models become better and better down the road? I think that gives you the forward-looking angle, evaluating those growth potentials of the companies ahead of the market. And the AI relevance, focusing on the fact, right? So even though a lot of people may hype up certain companies in the public market, we look at the fact. How many of their revenue is currently contributed by the AI-related product or features that they developed, and has it changed over the past quarter, past year, we are going to reflect all the progress, all the facts that have been made according to their earnings calls, the public information, and will be reflected in our AI score eventually. So that's how we construct our AI score. And I think being in the private market offers us another edge because the private market is very dynamic. Startups have been dreaming about disrupting incumbents every day. So they definitely offer a lot of the forward-looking and stay ahead of the curve capabilities for the private investors compared with the traditional public market investors. I think, let me give you an example. We have been watching what Perplexity and other AI chatbot have been building and trying to disrupt the traditional search like Google. And obviously, Google is facing a lot of pressure. But if you are really in the private market, you will know, the new chatbot, the new AI chatbot are not yet ready to monetize those traffic. And same as Google, if they were to monetize those traffic, it may hurt their user experiences. So we can't be really bearish on Google until real progress have been made among those startups in terms of monetizing those traffic. So through the lens of AI score, you could easily say that, does it affect Google's AI readiness? No, because Google's AI-related cloud revenue is experiencing strong growth, while advertisement revenue is not yet affected. So does it affect Google's AI potential? And no, because they have one of the strongest model, the best research team, and massive distribution, which may win the AI race beyond the chatbot era of the AI. So, that's how private market will allow us to have more forward-looking angle compared with other public market investors.
Right. I mean, you're seeing the whole ecosystem. It's phenomenal. And what I really like about the AI score is it's applied systematically. It's part of a very disciplined quarterly rebalancing process. So you're able to systematically buy low and sell high. It's not active management in the conventional sense. The part of the public companies that we track, that's done using a very traditional ETF framework, using an index. But this is a proprietary methodology that takes more into account than just how big the company is. So we've had some success with the strategy. It's growing, it's attracting new investments. And as the fund continues to grow, Max, maybe you could talk a little bit about the criteria we're using also on the private fund side. In other words, we've added 2 very good companies that are privately held. We're looking at others. Can you talk about those criteria and how you're thinking about what we should be introducing next?
Yeah, sure. I think in short, what we are looking for to put into our private sleeve, the ETF, is generational companies, because the concentration that we can have for private companies is only 15% of the total ETF. So we are going to be very selective, only looking at opportunities that the company may grow into a generational company. And Anthropic and xAI definitely are going to be first wave of those companies in the current act of AI. And looking forward, I think there are several criteria that we are looking at. One, I would say we are very bullish on enterprise AI because we believe that enterprise AI will be much larger compared with the consumer AI. Although ChatGPT have passed 12 billion revenue, and most of which coming from the consumer side, the subscription of the ChatGPT. But AI product that can transform an industry, for example, expedite drug discovery and invent new materials, enable reshoring of manufacturing to the US, will be our focus. And secondly, I think we have high conviction in the companies that can provide strong service capabilities. We always believe that off-shelf API can be easily used and adopted by the enterprise. They need extensive services to be able to embed it in production in production-ready environment. I think Palantir's latest earnings call offers some insights to that, because in the early days, Palantir have been challenged by, you are a service company, not a software company, so you are not going to be enjoy a lot of the gross margin, high gross margin like a lot of software companies have been doing. But in the end, they kind of win the AI race by providing a lot of service together with their AI capabilities. So that's another area that we are really bullish on. The third direction that we are bullish on is the data companies or data layer, because the model progress, slows down a little bit. I think it's mainly because we have used all the data on the internet. But there will be massively more proprietary data in the enterprise world, also a lot of which is not digitalized. So with the implementation of AI, an order of magnitude data will be extracurvated and created, will be even larger than the internet. So the data layer companies will have the opportunity to process, to train, and to make models better. So I think that's three directions that we are betting on for the future inclusion of the private companies in a private sleeve.
Excellent. Fabulous insights. This has been super helpful, Max, and I know everyone's appreciated the opportunity to hear from you on some of these questions. I know that we've got a number of other questions from the audience, and Derek, I think I'm going to hand things back over to you, and maybe we can formally start the Q&A portion of our panel.
Sounds great. Sounds great, Jonathan. Yeah, we do get a lot of questions. Just for any, if you have any questions, please email info@KraneShares.com or just submit the question to the Q&A box on Zoom. So I think first question for Jonathan, there's a lot of question on this. AGIX is provides daily liquidity. It's an ETF, right? How really manage that while holding private companies, right? Like xAI and Anthropic.
Sure, absolutely. So, much like any ETF, AGIX is trading throughout the day. And so an investor can buy and sell AGIX just like they buy and sell every other ETF. We are following the rules around not exceeding the 15% limitation on private investments, but we're able to operate like any other ETF in the marketplace. There's one critical difference, however, and by the way, this is not something that's new to KraneShares or the industry, the ETF or mutual fund industry, because quite frankly, mutual funds have been making very small investments to private companies for a long time. There are very large mutual fund complexes that own small positions in private companies, 1/10%, 1/3%. Our philosophy is a little bit different, and you'll find that in the case of Anthropic and xAI, those represent more than 3% of our funds currently. So those are larger positions than some of the mutual fund companies would hold in private companies. So what we have to do is fair value those private companies every day. And the reason you have to do that is because there is no market price per se, right? When you buy NVIDIA or you buy Microsoft or you buy Apple, there's a market price every day, and you can use that to price your ETF. With names like Anthropic and xAI, there is no public market data. So we have to rely on data sources that we receive from third parties that capture transaction data from the secondary market. And Max alluded to some of the secondary market activity, but we're able to look and see the kinds of transactions that are taking place in the secondary market, what the implied valuations are, and the data that we collect could also incorporate filings that are made by these companies. Remember, these companies are also doing new rounds, they're doing tender offers. So we're able to aggregate all this information, and then with our fair value committee, establish a price. And that price is reflected in our holdings and in the net asset value of our ETF, which then drives its value and its performance. So again, the concept of a fair value committee is not new. It's not new to KraneShares, but valuing these private investments is fairly novel and requires extra data sources, extra care, and a real thoughtfulness.
Yeah, just follow on that. I think there's a lot of questions around like, when did we bought xAI and Anthropic, at what valuation? Max, Max, do you want to answer that question?
Yeah, we participated in I think in Anthropic at last round valuation, and also xAI at the latest tender round, orchestrated by the company at a valuation about 113 billion.
Yeah, so we as we said, like I think March, we entered the Series E round of Anthropic, right? And then recently we joined the tender offer of xAI.
That's right. That's right. And that's really important. And this is when we talked about being on the cap table, that means that you're participating in a round, right? In that case. So Anthropic right now, there's some discussions out there that they might be raising a Series F round. And so we participated in that last round. We entered successfully. I think the round valuation at that time was 61.5 billion. There are some numbers being thrown around about what their valuation might be this time, but I would still place that in the rumor mill category and wouldn't rely entirely on those numbers. But there's a recognition that the value of Anthropic will likely increase meaningfully from the prior round to the round that they're doing now. And so as we've been monitoring the secondary market for Anthropic, we have seen it trending up, and that's being reflected in the value at which we hold the company in our net asset value. Now, once that round is completed for Anthropic, our value of shares will increase to match the value of that round. So there is a bit of uncertainty as we go in between rounds, but once there's an amount that's solidified for valuation, then the value of our shares will be adjusted to reflect that new value of the company. And just to be very clear, right, this is a process that allows us to adjust upwards and also to adjust downwards. If companies are raising money at lower valuations, then we would have to adjust accordingly as well. So it's a symmetrical process. It's not a one-way street, and it's well thought out.
Yeah, I think next questions for both. We have seen like some recent inflows to the fund. So how do we plan to maintain the private exposure to the private companies?
Yeah, and I'll start, but I think it's very important to, really think about what Max laid out as always having a view on what we want to target, the quality of companies we want to target, and the areas we want to target. And so at every point in time, we have a short list of potential investments. Now, the timing doesn't always work out perfectly because that company has to be out there raising capital. But we have a good list of companies that we're targeting. So as the fund continues to grow, we expect to continue to make new investments. And so my view is that, at 50 million, we have two names, but you could see that as the fund grows to 100 million, 500 million, $1 billion, we'll continue to add additional private companies and further diversify the ownership that we have and capture kind of the most important trends and themes that are taking place within the AI space. Max, what would you like to add to that?
Yeah, I think that's perfectly said. And aside from that, even for existing companies, existing portfolios that we have, like I said, we want to be their partner if they grow into the generational companies down the road. I think being on the cap table will allow us to have access to the future rounds that they are going to raise, So, we are going to work together with the company and to allow our investors, allow our product to have more and more exposure in those, generational companies until IPO. I think that's our goal.
Yeah, that's a great point. We don't have to just buy new companies. We could continue participating in the new rounds of existing firms as well.
Yeah, I think we just have like a Robert asking like, yeah, we do bought xAI at 113 billion, right? Just confirm. And Anthropic at 61.5 billion. Yeah, so yeah, we can confirm that. Then I think the next question, we have some investor actually worry, like, what if that there's a risk on AI if the AI growth slowing down, or the scaling law hit a wall? We've been hearing that maybe on the news or some like media covered that worry. How do we really think about, like, in the past we may outperform like NASDAQ and many other indexes? How do we see it going forward? Will potentially drive the performance in the future?
So I
Yeah,
think,
I think.
yeah, Max, I think.
Sorry, go ahead.
No, please, you're really well suited to answer this. I'll make a couple of comments at the end.
Yeah, I think regarding that, right now we are living in a time there are a lot of uncertainties, right? You have geopolitical risks, geopolitical conflict, macroeconomy, labor market, and supply chain disruption, you name it. But what we are betting on is the certainty that technology advancement is, one of the most certain thing, according to, all the technology waves historically. So what that certainty of technology advancement will do to the portfolio companies in AGIX is what we are very much focusing on. So we believe that with the advancement of AI technology and with better and better models, it will significantly improve the, both top line and bottom line of those portfolio companies, that they will generate a lot more stream of businesses, increase their operational efficiency, and as a result, perform well in terms of stock prices. So I think that's the, certainty that we are betting on. But at the same time, a lot of people have been saying, if you look at top 10 holdings of AGIX, there are a lot of overlap with the, mega tech companies right now. I think the reason for that is because those companies are the early stage AI winners, given they have capital, they have data, they have compute, and they have talent. But with more and more kind of AI native companies being IPO'd, and with more and more diversified portfolios that we are going to include in the private sleeve of the ETF, it's going to become more and more different compared with the traditional legacy indexes.
Right. Yeah, and that's where I take a lot of comfort. I recognize that the tech space has done very well. I referenced the significant performance of NASDAQ, not just last year or the last 5 years, but for 20 years. However, where I take a lot of comfort is that this index was constructed to be durable in a couple of different ways. Way number one, we're not just cap weighting everything. We're not just going for momentum. And so I said before that the top 10 holdings within the NASDAQ 100 represent more than half the index. Our top 10 holdings represent about 40%, but two of those names, 7% of it, those are private companies. They're not even listed. So really, our public company concentration within the top 10 is only about a third. So I view us as being more diversified or less concentrated, while also giving access to a huge part of this AI market that, quite frankly, is very hard to access. And that in and of itself should also provide some diversification benefit. So I agree. You can't predict the future. Companies go up and down in value. This is a very big trend that will be volatile for sure. But I feel like we've designed a strategy that creates a combination of features to give upside potential, but still being thoughtful about risk and how we take risk.
That's great. Yeah, there's several questions asking about our future plan of investing more AI companies, private AI companies. Are we considering private companies overseas? Maybe Max, can you talk a little bit about our criteria or like the thoughts around like adding the AI private companies in the future?
Yeah, like I said, we are bullish on the three directions: the data layer, the industry specific foundation models, and also the service-led growth companies that trying to apply the AI technology into different verticals. I think that's the three areas that we're looking at. And regarding if we are gonna include model companies or AI companies outside of the United States, definitely yes. We are trying to build a portfolio that can offer global exposure, representing the top quality companies, generational companies globally in a portfolio. So yeah, by the time we will definitely consider include some of the other AI companies outside of the United States.
That's great. I mean, then Jonathan, give your background in the asset allocation. How do you see like AGIX as like hybrid ETF, but with like high growth potential in the AI? How should investor really position AGIX in their portfolio?
Yeah. I think that there are two ways to think about asset allocation as we move forward. And it's really quite evolved from history. Historically, if you were a very large institutional investor, you would have a separate asset class called private equity or venture or hedge funds and those types of things. But that requires you to be of a certain size and have certain unique access. And you would probably put 20% of your portfolio in those private type assets. Well, the reality is, with the hybridization that we're seeing taking place, that we're part of with AGIX, but other firms are also part of, I think that the need for many investors to have that separate asset class goes away. I think when you think about equities, instead of calling them public equities, they're just equities. And within that equity sleeve, you have private and you have public together at roughly a 90-10, 85-15 weight, which is, by the way, very appropriate for most investors. In other words, if you think about the sweet spot, that's not all that different from what some of the largest, most sophisticated investors would do in allocating between public and private. So I'm very pleased by this innovation and this capability, because I feel like we're giving everybody the ability to allocate assets and build portfolios that are very close in quality and sophistication to what really the largest institutional global investors are doing. So my view is you don't have to make the differentiation anymore. You can call your equities equities and use funds like AGIX to achieve that private exposure directly inside your equity sleeve.
That's awesome. Yeah. I mean, like, with like, there's more and more innovation happening, I think, around the KraneShares. We're really providing something unique and that investor actually can position in the portfolio. So I think that's very critical. So with that, we're going to conclude the webinar today. Thanks again for everyone to join our discussion. And for the questions we haven't been able to address, we're going to follow up on email. So thank you, everyone. Thank Max and Jonathan for today's discussion. Thank you.
All right. Thank you.